Greetings, Jonathan Camarda, as we move through alas, chilly November. And so what did we talk about last time? Last 2 days of October, first 2 days of November, a pivot, a kick, perhaps Michael Phelps style, off the side of the pool from a bearish trend to perhaps a new bullish trend to finish the year. Too soon to say. So a few things looking at. We saw interest rates, obviously, in the 10-year yield came down. What we talked about, a fever-pitched 5% plus, down to about 4.53%. Jobs data came out, 150,000, way down from the 279,000 October to September, or October from September, rather. And wage growth, slowing as well. So again, a lot of that has come down. In confluence with last Wednesday, Fed Powell basically declared, again, no rate hike, obviously, in November. A lot of folks think that they may be done, period, at least done for the year. Now, there's still some hawks swirling. It is harvest season, after all. That thinks that it could be another quarter point out there to some extent, that inflation is not dead. Again, there are some shades of gray, certainly, to be looking at. When you go to the grocery store, most of the common, you look at the economic data and the polls out there. We're not going to get into that. Things are still expensive, so there is that inflationary situation. But from a pure Fed standpoint of looking to get to that Goldilocks 2%, they may just try to get the ball close to the tin with a lot of the repercussions of continued tightening without seeing how that medicine moves through the veins of the proverbial patient, the U.S. economy, and really the global economy as well. Now, speaking of global economy, some of the things that we're looking at from a macro standpoint, we like to look at the institutional options markets, put-to-call ratios. Again, higher put-to-call ratio, more bearish, lower, more bullish. You get to extremes. Well, the put-to-call ratio got to late last year levels of about 0.85 and have receded down into the 0.7s. We saw, of course, a bullish move with that as well in markets. And then the U.S. dollar, right? We talked about the overhang, the gray cloud from a macro standpoint. After slumbering for the first 6.5 months of the year into midsummer, the dollar started to come alive along with that 10-year rate, right? And then we saw, again, the markets really take that downturn. The dollar now is kind of in a break mode, falling versus the euro, the yen, the Canadian dollar, the Aussie dollar, the bloody pound, basically against a basket of currencies, and that gives a little bit of a tailwind for markets from here. Now, seasonally looking at sectors, surprisingly, maybe not so surprisingly, utilities had a real good week last week, and even the financials, which generally you would think they do better with higher rates. Rates come down. They have a great end of the week. There are some perplexing moves out there. Now, folks that are calling for that soft Goldilocks landing or even no recession, not sure what textbooks that those folks have read or their education level that I'm watching on TV. However, it's only happened about 3 years back, 60s, 80s, I believe maybe early 90s, where we did have that perfect touchdown on the runway. Again, nobody really knows what's going to happen, but a soft landing may be a little too Goldilocks, so to speak. Now, when we start to look at what the Fed's going to do, really too early to tell, but there are some positive signs that perhaps they have slowed down to maybe a complete halt. That could be good news or it could be bad news. With rates coming down on the long end of the yield curve, could also be negative for stocks because what is out there in the distance that we don't see now that is in the system? Again, you never know until it hits. We have some credit situations. Of course, you have a lot of commercial real estate loans are going to recalibrate over the next year and such. And with higher rates, it's already been a hard hit out there, could get worse. So those are the things that we're looking at. Markets right now, we have to see. Technically, we'll finish on that. The markets, the S&P, the Dow, the NASDAQ are all above their 50 and 200-day moving, 221-day moving averages. However, again, for you technicians out there, the 21-day moving average is below the 50-day moving average, which is still pretty bearish. That means, again, faster moving, right? The lower amount of days, faster moving average. You want those to be above the slower moving averages, which says the current trend is up. That is not the case with the 21-day being below the 50. However, the price popped above both. What does that really mean? Well, it's kind of like a pair of twos in cards, right? To quote the old great Carter Worth on CNBC, we shall see. With that being said, we'll see how this progresses. The first couple of days of November with the handoff of the baton from the last couple of days of October, with the macro trends changing, not to mention the geopolitical backdrop. Stay frosty. A lot easier this time of year than it is midsummer. We'll stay eternally vigilant. Till next time, Jonathan Camarda, pleasure to serve.